Global equities have been driven upwards by the power of central bank and government interventions all around the world. Governments have been spending money they don't have, borrowed money, and central banks have been printing money to finance that, quantitative easing. More than that, the US Federal Reserve and the European Central Bank are now buying corporate bonds as well. But for all of that massive central bank firepower, this rally has lacked conviction. Whilst the S&P 500 index had been surging from late March, volumes had been declining, and this rally has been dominated very heavily by 5 stocks: Microsoft and Apple, Amazon, Alphabet, Facebook. Technically, this rebound has been within the experience of bear market rallies. 50% and even 61.8% so-called Fibonacci retracements are not unusual in bear markets. These retracements are partial recoveries of losses from previous declines. And indeed, we have seen a 61.8% retracement of the steep fall from mid-February to late March. And the index is now starting to hesitate. Central banks can and will act to prevent the pandemic evolving into an acute financial crisis. But that means focusing on generally well-run major corporations. I cannot see them saving the entire corporate world. Meanwhile, the economy and the stock market continue to diverge. The S&P 500 ended the month of April with its biggest monthly gain since January of 1987. But last week, the US announced that its first quarter GDP fell 4.8% annualized, despite that period having captured only around 2 weeks of economic shutdowns. The second quarter decline will be an absolute horror. The US Conference Board's central scenario expects 33% annualized contraction in the second quarter, resulting in 6.5% decline for the full year. The S&P 500 index has also been diverging from corporate earnings. The estimates of S&P 500 earnings have been coming down since February. As of late last month, the market was expecting a 17% decline for full-year earnings. Now, as bad as that sounds, it can get a lot worse. During the global financial crisis, S&P 500 earnings fell 40%. That's right, 40% in 2008 compared to 2007. There has been some optimism with the US starting to roll back restrictions. Well, the University of Minnesota last week released a timely report which warned that of the 8 major pandemics since the 18th century, 7 of them saw a major second wave of infection. The center outlined 3 scenarios. All of them involved subsequent waves of infections. So is the bear market over? I don't think so. But as always, good luck in the markets and stay well.